Good morning. Welcome back to the Retirement Report. I'm Hank Parrot, your host. All right, I was sharing some things from the Morningstar report, and basically what it had to do with is talking about flexible withdrawal strategies, but these with that, basically, in other words, again, taking out less when the market is down, and then of course flexible spending, not spending as much money. Variable strategies tend to lead to lower residual end of life balances. So if you're not concerned about charities or your family, you don't need to, maybe you're single, maybe, this is just you just need your money to last your lifetime. You're not needing anything beyond that. Well, this is what he's talking about. And I've got clients that we've laddered up income streams where we can start them at one point, and then 5 years later it increases, could layer on top of the existing, or it could take the place of, depends on what our overall, well, it basically depends on the individual and what we're looking to accomplish. But basically through this process, we keep their income going up over their lifetime. We assure they're not going to run out of money, that they're going to have guaranteed income for life no matter how long they live. That's one of the strategies. And you can blend those with a portfolio. There's all kinds of ways that you can make this work based on your individual situation. The right level of flexibility in a retiree spending system, again, they go back to that, will depend on specific situation, the extent in which fixed expenses are covered by non-portfolio expenses. And they say one way to do that is through annuitization. So what they're talking about with annuitization is, for example, you have an annuity, and that annuity, you have a couple of different ways typically that you can take income from it. One's called annuitization. I have whatever amount of cash. I say, okay, here in my annuity, I say, here you go. You take over my annuity and you give me a guaranteed income stream, and I can do that for a fixed period, like 5 years, 10 years, 15 years, or I can do it for a lifetime. Okay, so it depends again on your individual situation and what the overall plan is going to look like. So if I take the lifetime income, I have now swapped off I no longer have that money, I have the income. And no matter, how long I live, and you can do 5-year periods certain. You can say, well, I want it to at least pay out to 5 years. If I died within 5 years, it'll still pay. But I want guaranteed life. That's my biggest. And for 2 lives could be for husband and wife. So what you do with those is, again, it's finding the right fit for you. That's an annuitization feature. And then they have income riders, which typically have some type of fee attached to them, but maybe give you enhanced income options, and any balance left, you haven't given away the money. Okay, so any balance left can still go to your family or charity or whatever your situation might be. All right, so BCA enhancements. Let's go to this first piece. This is a piece we got from Athene and Annexus, and I'm going to talk to you about how this can work. So for instance, BCA, this is an example of a product, and I'm just going to hit some highlights with this. If you're looking for accumulation, basically growth, if that's the biggest goal, then how you use this product, or which, the variation on it, will be key to maximizing growth. If on the other hand you're looking at income, they have enhancements for that as well. So this is where I mentioned about an income rider that you could elect that could give you increased income over your lifetime. And then the legacy piece, this is where, again, they have different, it's like different riders, or you can imagine you're putting different parts together to accomplish your specific goals. Now, there's not that many. Okay, it has to do with the investment choices. It has to do with a few riders. There's, I think, there's one income rider option. Legacy, there are 2 options, and then accumulation, there are a number of options. So let's look at accumulation, okay? And the way they do that is through different indexes. So I've talked about these on the show before. Shiller-Barclay's Global Index, and you can see these are global indices, Merrill Lynch, RPM Index, and the Citi Grandmaster Index. And then you have those that are just U.S. only, like the Wisdom Tree Siegel Strategic Value and the Shiller-Barclay's Cape Allocator 6. Now let's look at Shiller-Barclay Global. And in fact, Dr. Robert Shiller He's a Sterling Professor of Economics and Professor of Finance at Yale University, best-selling author of Irrational Exuberance, one of the world's most influential economists. Very true. And he won one that I'm surprised is off there is he also won the Nobel Prize in economics back in 2013. So Dr. Shiller has developed this Shiller Global. He's actually got two indexes. One is the Global. It's got 23 commodities, 400 stocks, 300 bonds in the United States. In the Eurozone, 140 stocks. And in Japan, 320. So that's a more diversified portfolio over both U.S. and international. And then we look at how they then use that. There's 860 global stocks. And they take that 860 global stocks with 20 years or more of history, so they've been around a while. They're evaluated by the CAPE ratio to identify potential values. That's then reduces down, think of this as a little funnel, down to 200 value stocks, diversified stocks in each region with low CAPE ratios indicating good value and evaluated for 6-month momentum. In other words, how have they done over the last 6 months as far as increasing? So they're looking for value stocks with strong momentum. That brings it down to 160 they have selected. 80 U.S. stocks, 40 Eurozone stocks, and 40 Japanese stocks, all with the strongest momentum, are selected. Equally weighted, mean they're not, it's not a market weight, the way we've talked about the S&P, for instance, where your top 25 companies make up 40% of what kind of return you're going to get. Here it's equal weighted across all the 160 stocks. Multi-asset allocation. 60% of Shiller Global Value stocks, 20% again commodities, 20% bonds. Overvalued asset classes are those with negative momentum are replaced with cash. So again, they're looking at things. Momentum is the key here, and looking at past performance a way to get there. And on the next chart, they show the compounded annual return over about 20 years being 4.87%. Now you can, depending on participation rates, what you might see from that, but this is an example of how you can, of this global one. Now I want to show you there are others. So if we look at the BCA, mentioned that you can get participation rates that are actually higher, right, than your, higher than 100%, in other words. So it seems unusual, but this is a way they can put these together based on most instances having a fee to increase performance. So if we look at the average 10-year period with the global, we see that at about 4.98%. Now that's if you pay this fee that they have. Without the fee, it's 3.86, and then in the Shiller Global blend of 65% with charge and 35% with no charge, so you can mix and match, 4.59. So there's a lot of different ways you can control these. Now that one I don't use as much in my practice. There are times, but right now International and Global, I think, are still in for a rough go. So let's talk about one of the things that's kind of giving you an idea, just basically, of how these things are put together and a little bit about how what the concepts are behind them. I'm going to share another Shiller with you, and this one is the Barclays Cape Allocator 6. Now what we're seeing here is this is a U.S., all U.S. Index. So again, there's a monthly reallocation process. So each month, they look at 11 market sectors of the U.S. economy that are evaluated using the relative CAPE indicator again to identify potential value. And then they bring that down to the 5 most undervalued. Because what do we know? If they're undervalued, that means they're priced low, and the likelihood of them going up is even greater. So these 5 most undervalued sectors of the 11 are identified and compared for 12-month price momentum. Recall the other index was 6, this is 12. They're looking back 12 months, and each month they look at that again to see which ones are still going up, which ones have the most momentum. And that's where the market sector with the least momentum then becomes identified out of the 5, narrowing it down to 4. because they're figuring that the worst one might be for fundamental reasons, and likely is. And that we don't want to fight. So select 4 market sectors with strong momentum, best value, and allocate it equally again, providing a balanced opportunity for returns. So this is the way this one works. So you have some that work on market sectors like that and some that work on market caps, in other words, the size of the companies. Tactical reallocation helps provide smoother returns. And what this is doing is it's shifting between how much is in equity and how much is in bonds to try to control the volatility. So they're looking at momentum. They've narrowed down the sectors to accomplish that. And when we're talking 11 sectors, this of course is 11 market sectors like financials, consumer staples, consumer discretionary, medical, real estate. These are all sectors of the stock where the stock market is broken into different sectors as opposed to the size of companies. And you can see the return on that one. So here we want to go to the backcasted performance. And again, the Shiller-Barclays Cape, when we look at that one, 160% participation rate with an annual charge of 1.5%. Average is 10 years. Okay, the average 10-year period is 8.2, so it's done phenomenally well. Its lowest period 5. Now, if you take out the strategy charge, so you don't have any fee at all, then it's the average, though, drops down because they don't have as high a participation rate, and you're looking at 5.7 or 3.92. Okay, now this is one of the things I want you to understand about these indexes is these are different. These are ones you probably haven't heard of, right? The Shiller Cape you may have heard of Dr. Shiller. However, if we look at the next one, which is going to be Citi Grandmaster, it's going to be different. And we're going to look at also, so a lot of these are partnered up with different banks. Citibank, Barclays, Bank of America, there's a number of them. We're going to talk about Merrill Lynch and some others as well. So there's a lot of things to take in, but this is to help you understand, just to identify some things you might want to be looking for when you're comparing. All right? And we'll get some papers out to you as well. Okay, first a break. Join us here. We'll be right back on the Retirement Report.